Hi dear traders. Wall Street was on a roller coaster last trading week. Market sentiment was mixed. The major stock indices were gyrating in the run-up to the Fed's policy meeting. The first response to the aggressive rate hike defied expectations because the market reversed upward. Nevertheless, Wall Street closed on Friday with the worst weekly losses since the pandemic crash in 2020. For the time being, stock investors have to deal with the steady bearish trend. A technical rally is likely to follow, but the market has not reached the bottom yet. So, market participants are braced for more jitters ahead. The question is how deep the market will fall and how many bearish waves will follow. Investors are trying to puzzle out what levels the market will hit the bottom and whether the crash of the last week could be considered a climax. Anyway, market jitters are ebbing away. Inflationary pressure on equity markets is expected to weaken in the second half of the year. Investors are going to digest the dramatic rate hike this trading week. They are estimating the prospects of the US economy in the context of the rate hike by 75 basis points. Mounting recession risks pose a threat to the stock market. Investors compare the current situation with the financial crisis of 2008. Will the market develop according to this pattern? Keep close tabs on developments in financial markets. Last week, the Federal Reserve ventured into the sharpest rate hike since 1994. The decision didn't come up as bombshell for investors who were already pricing in that move at that time. The Fed made a logical move after inflation data with the CPI at a multi-decade peak. So a modest rate hike would have caught investors off guard. This accounts for the first positive response on Wall Street. Key stock indices recovered on Wednesday. The Dow Jones closed 303 points up, the S&P 500 1.5%, the Nasdaq gained 2.5%. Investors considered the sharp rate hike to be a proper measure against high inflation. They were also encouraged by the hawkish rhetoric of the Fed's chairman at the press conference. The euphoria was followed by disappointment. Investors are stoking fears about the looming recession. Thus, they are wondering whether the US Fed will be able to take such drastic measures that will not hurt the economy. The rate hike by 75 basis points is not a one-shot move. Jerome Powell indicated more aggressive tightening to follow. Besides, a few days later, after the meeting, Fed policymakers assured the market on a tough approach to inflation at the next policy meeting. On Thursday, Wall Street indices reversed downward as investors realized the gloomy prospects. Since then, stock indices have stuck firmly on bear territory. The Dow Jones lost over 700 points on a single day and fell below 30,000. For the first time since January 2021. The S&P 500 and the Nasdaq dropped 3.1% and 3.9% respectively. The weekly loss of the Dow Jones comes in at 4.8%. On Monday, June 20, the Dow and other key indices made an upward correction. This was not a trend reversal but a breather in the thin market on the US public holiday. A variety of factors indicate a further bearish trend. Stocks that hit lower lows are more numerous than stocks that print new highs. This difference commonly prefaces the situation when the market hits its bottom. Even during recent attempts to develop a correction rally, the stocks having printed higher highs slightly exceeded the stocks having hit lower lows. The positive delta was recovered only a few days. All in all, it's too early to speak about a termination of the bear market. The downturn in the extremely oversold market doesn't mean that stocks have hit their bottom yet. Investors are looking for some links between the current situation and the crisis of 2008. Back in time, losses of some indices were more than 50%, which is more than twice bigger than the ongoing slump. Looking back, the whole financial situation was on the verge of a complete collapse. So it's wrong to draw this parallel. The current problem is broader and it's driven by different forces. The S&P 500 lost 5.8% last week. The bulls and long-term investors are facing a challenge. The index broke the low of May. That means a 20% fall since the record high in the early 2020. The S&P might head for a lower level of 3,390. This level was recorded in February 2020 before the pandemic crash. What's going on and what expect for the barometer of the US stock market? Hardly anyone predicted such a dismal slump. Analysts reckoned that 3,855, from which the bear market began, would become solid support. Previously, the S&P 500 used to take a pause at around this level before a further decline. The index might return to the pre-COVID highs. As for the nearest outlook, the index is expected to break the crucial level of 3,855. Then, the sellers will push the price down to the target of 3,500. It could serve as interim support. The hawkish Fed poses obstacles to the stock market and economic growth. Analysts downgrade forecasts of the US GDP for this year. The level of 3,900 is seen as the peak for the S&P 500 since December. Depending on further developments, this high could be revised. Both the Nasdaq and the Dow Jones shed 4.8% last week. A corrective rally on Monday didn't provide much help. We can hardly improve the outlook for index of high-tech stocks. Notably, analysts sharply upgraded their forecasts of a recession scenario for the year ahead. Now the probability is measured at 44%. In April, this indicator was 28%. Oftentimes, the current figure is mentioned when an economy is on the brink of recession or has already entered recession. Earlier, the U.S. Treasury Secretary defined inflation as unacceptably high. Joe Biden confirmed that a recession could be hardly avoided. On the other hand, a fall on Wall Street looks exaggerated. Moreover, investors have already priced in recession in market quotes by 85%. Amid the bear market, some analysts come up with the assumption about a possible rebound in stocks that have taken a too deep nosedive. Zoom is one of the companies that are expected to recover. Its shares have lost 40% in value since the beginning of the year. Demand for online conferences grew during the pandemic. Despite the massive return to office work, teleworking has become the mainstream. It means that Zoom stocks are set to enjoy buy-on demand with an explosive jump in market quotes. Not all analysts are over-optimistic. Half of them are cautious and realistic. Nearly 30% of analysts think that Zoom shares are good long-term investment. Shares might trade at $153.60 a piece in 20 months. So the potential growth could be almost 40%. Tesla shares traded with high volatility last week. They recorded the biggest losses at the end of the week. The prices plummeted 8.5% intraday, having tested support $625. The fall was triggered by the overall weakness in the stock market due to sell-offs in the energy and high-tech sectors. Another headwind is the news that Elon Musk's company raised prices on Tesla cars. They used to be costly, but each price tag has increased by $2,000 to $6,000. Investors have a negative response. Indeed, raising prices amid tough competition is not the best strategy. Keep close tabs on developments in financial markets on InstaForex TV channel. Welcome to leave your comments below this video.